Welcome to this walkthrough of the Blockbuster Product Financial Model template from efinancialmodels.com. The purpose of this model is to provide an Excel financial model template when you are dealing with the market launch of a single blockbuster product and where you want to obtain funding from investors, and by doing this you need to outline them your business case. A blockbuster product normally will face huge demand, and the bottleneck at the beginning is the available manufacturing capacity. This model helps you to build out a scenario for your production ramp up and builds the financial projections over a 10-year period. The structure of this model is as follows. We have here three main sheets. One is the executive summary sheets, which contains the main outputs of this model and the main assumptions. Then we have here a calculation sheet which contains mostly the main calculations of the line items, and then here we have a financial projections sheet which contains the three financial statements: income statement, balance sheet, cash flow statement, financial ratios, DCF analysis, and then also the calculation of the funding required and the calculations for up to 10 investors, how much returns they can expect, how much they need to invest, how much equity stake they will be given. So I will shortly lead you through how this model works. So at the first place we have here one schedule on the executive summary sheet where you can play around with the new production capacity to be added. So you can simply say how much more production capacity here measured in units per day will be added. We have here one factor which then calculates what is the cost for adding more manufacturing capacity, which then also means the budget required for machines will go up or it will go down depending how much manufacturing capacity you will add. So the idea is that you can play around with different scenarios to build up your production manufacturing capacity. Then the calculations, the affected calculations will be on the calculation sheet where you have here the production capacity per day. You can enter how many production days you can expect by for up to 10 product lines, and then we'll also output what is the yearly production capacity for these 10 product lines. And then we can also say once you know the capacity, you can estimate what's the foreseeable utilization. We have here a factor of 90%, but you can also change that as you like, and important is that you obtain the production figure of your product for the next years. Then another important factor is your pricing. This model is for one product only. That's the whole idea for this model, that we have one blockbuster product, but this blockbuster product we can sell through various sales channels, and we have here up to 10 sales channels available where we can say how much of our production will be sold to, and these can also be built up over the years. And then also the pricing of these sales channels can be different. So I have here a table where we can enter different pricing scenarios for these tables, and then we can sum up and calculate what is the foreseeable revenue of this ramp up and our sales strategy. Then the next topic is production costs. Here we make our life a bit simple. What we assume mostly is production costs are very simple, as production can potentially be outsourced to a third-party manufacturer, so he will only charge us basically the cost per unit, which is way easier to estimate than if you have to go through all the raw materials and all the details of a production process. So we keep it quite simple here and we focus on the main assumptions. Apart from production, there can also be an assembly task involved. Either there is assembly or not. We can then also simply just overwrite here our assumptions. Our assumptions are always in blue, so you can easily identify them, and you simply can enter better values for your business case and play around with this as you like. The next step in our process is packaging and then shipping. So all these costs gives you the direct cost for your product, but of course there will be also indirect cost. You will have to incur costs as well for sales and marketing. So this means after the gross profit line, which just includes the revenues minus direct costs, you will also have to estimate how much is the overhead cost for sales and marketing, general admin, other operating costs, and we also have here a line item in there to play around with sensitivities and scenarios just to understand a bit better the effect of different cost structure. The bottom line is that we want to calculate this line here, which is the EBITDA of our business plan, which is very important, and this is something every investor wants to understand to basically understand when your EBITDA will become positive and how much EBITDA will be there, as this will affect the evaluation of your company at the very end. On this sheet, also just to shortly go through that, we have here additional calculations. They are meant in a say that you can better validate your business plan. So we calculate also how much profit per unit this means, what is the EBITDA per unit. Then we have also here a schedule to basically simulate your, we have up to 3 layers of financial debt, and then we also have a fixed asset schedule where we take basically the capex assumptions from the executive summary. So depending what you input here, it will flow through the calculation sheet here, and then this will result in your gross fixed assets going up, and below we do the calculations what will be the yearly depreciation depending which assets you have. And you can see this is mostly driven by the years these assets are being depreciated, and these years can be inputted and changed also here basically on the general assumptions sections, depending for each asset. So this basically is the purpose of this calculation sheet. So this means we have all the calculations ready which we need to build up our financial projections. This takes us to the next sheet. So now what we do is we build the income statement by aggregating all or taking the sales forecast we have built, cost of sales, operating cost, etc., and we build the income statement. Some assumptions then will also come from the general section. For instance, like the tax rate, we can simply input one tax rate here, and it will flow through. It will flow through the income statement here in your forecast. What we are also interested to understand is the forecasted balance sheet, and so here we also build up the forecast of the balance sheet, the forecast of the cash flow statement, and this is mostly done also with the help of some of the financial ratio assumptions. For instance, all the net working capital items, they are based on days receivables, inventory, payables, so you can input that in your executive summary sheet. It will flow through here, and then depending on this ratio we calculate what will be the expected development of your accounts receivable, inventory, and other net working capital positions. What else? We then also calculate the rest of the financial ratios, as we want to obtain a comprehensive picture of our business plan. And in case one of these ratios looks out of place, looks strange, what we want to do is that the model tells us this, and then we have a chance to go back and fine-tune our business plan until it makes more sense and the quality of our financial plan becomes more logical, and the quality increases. We then also have a section here, which is the DCF valuation section. This is the key parameters are driven here. Also, then if we go back on the executive summary, we can enter different discount rates. We can enter what will be our exit valuation assumptions. We make our life quite easy and simple. All what we do is we assume a certain EV/EBITDA multiple. You can enter it here. It will flow through the model here. And then what we do is here we take our 10-year forecast. At the end, we add the terminal value. We discount all this, and this gives us the DCF valuation of the enterprise value. If we subtract the net cash, will give us the equity value, and then we can also calculate what's the value per share as well as eventual financial ratios. However, in this case, if our business is small at the beginning, it's not as relevant. What we want to understand is more what's the impact of our business plan on the DCF valuation. Then the next question, our topic we want to understand is what happens if we change certain important variable. What happens to the valuation to the DCF valuation? So we have here two sensitivity tables, meaning if we increase the exit valuation, you see here our DCF value goes up. These graphs will tell us by how much. As we'll see, it will go here slightly up. If we decrease our exit value, our valuation will go down. Same here with the discount rate. Increasing the discount rate leads in a lower value. Decreasing discount rate will lead in a higher value. So we can understand a bit how this model reacts to these two parameters. Then we do the same also for other two parameters. In this case, we have assumed our business plan results here in a certain EBITDA margin. So the question is, what happens if we reduce the margin, and what happens if we increase the margin? Here something looks out of place. This looks out of place. Voila. Hold on. That's not correct. This one should be like this. Hold on. No, it's not correct. So what we want to do is we want to take this value plus the change in here, so that the margin goes up to 38 percentage point, and then this is the resulting DCF valuation if our margin is decreases. So we just take this minus, in this case it's a plus, hold on, voila. If our margin goes down, then basically the DCF valuation decreases. So the calculations here were correct, but just this here was cosmetically not correct. So I've fixed it. So once we know how these parameters will react, this allows us to build this tornado diagram. And if we look here at these four factors, it's pretty clear that actually the most important driver is installing additional capacity. Of course, this assumes that there is demand for our product, which should be the case, but nevertheless, it always needs to be validated just to make sure that we don't do a costly mistake. What this model tells you is if we would be a bit more, if we actually can even increase manufacturing capacity further, there we can make additional money based on this business plan, as then the DCF value will even jump up. So that's all the topic about DCF valuation. Then the next topic is about how much funding do we need to execute our business plan. For that, what we do is we look at our free cash flow to firm. We look what's the cumulative free cash flow to firm and where does it peak. That's this value here. And this means we need to organize that much of funding, and it will cover us for the period here up to 3 years. So when we go back to the uses and sources of funds table, so means we need 1 million of funding. We will have a look at our business plan, and we will see that quite a lot of that will go in capex and some other stuff. So what we will do is we will, in this case, we'll allocate our budget and clean this up. In case we want to have some buffer, here you see this figure is rounded, then we would have to override this value here. Maybe I can mark it in blue. That's just a suggestion, but you can overwrite it, and then if you want, you can add more buffer to it. Once we know how much funding is needed, we have another look at our financial projections, and what we want to make sure is that our cash position doesn't get negative. You see here it's slightly the case. The reason is we have here some debt financing and this costs us some interest. So this can be the case. In case we don't have debt financing, you see this will actually even be positive, so that was the reason. But in our case, let's say we have some debt financing. This debt financing, if you remember on the calculation sheet, we had the debt schedules, and you see also here we have the interest rates. So let's say these costs are going to happen. Then if we have here a negative value, we need to add a bit more buffer. So let's say we just raise 200k more just to be comfortable. Then you see we have a bit more buffer in our business plan. But this also means that we will have to organize a bit more equity funding, and we also need to check if we get this equity funding from investors, what will be their situation. So let's have a look at this. So we need to figure out what is the shareholder structure. So let's say we want to give away 40% of the company's share in this funding round. So let's say the founders, they keep 60%, all new investors who will basically together get 40%. And then we want to see how much money they need to put out. Here I've put in some formulas to calculate that, but this can be overwritten. The point is we need to calculate what is their expected multiple and their expected IRR. And here the point is we need to assume a certain scenario. Let's say we start here in 2020, but let's say this is at least an 8-year investment horizon, just to be sure. Maybe it takes longer than what we think. We just want to be conservative. And then you see the IRR stay adjust, and what we do here is in financial projection sheet. If we go, we have here the section funding required. We have here a section where we project the company's valuation, and then we also calculate if we put in 750 here of equity, if we get it out in 8 years, that's how it look like. You see investors benefit from some dividends. If the company is profitable, there should be some excess cash which can be distributed in form of dividends, and then when getting out you will have the exit proceeds in year 8, and this gives you the expected IRR. But this is for the project overall. In case you see, in case we change here the price of these shares, let's say we have 10%, but instead of giving this away for 187, we give this away for 200k. You see, this impacts their IRR, and what these calculations do is they basically outline the cash flows on a per investor basis, how much they need to invest, how much dividends they'll get, when they get the exit proceeds, and we calculate basically their returns, investment, the profit, proceeds. We calculate the multiples and we check the IRR. So now what we want to make sure is whatever we offer to these investors, it has to be attractive, has to be compensate them for the risk. So that's why we need to understand the situation, and that's why we need a model to basically play around with with our scenario. So that's pretty much this section. Then we have here another section, pre-money and post-money valuation. What this means, just another check we should do, but the point here is this is lower than our DCF value. So actually, from a valuation perspective, it's a good offer because they get more upside than what potentially this company is worth at the moment. but of course in this case all this needs to be negotiated, and we don't want to it has to our offer has to address what their investors really want, and what they want to what kind of return they expect we have to offer them. Okay, so this is pretty much a complete walkthrough what this model is able to do. I hope this was useful. It gives you a good idea how you plan out the financial future of your next Blockbuster product. If you like this video, please give it a thumbs up. Don't forget to subscribe to this channel and visit our website efinancialmodels.com. We include a link to the model in the description below. Thank you for watching.